Everyone, it's Zach back with a new mortgage video. If this is your first time seeing one of my videos, welcome to my channel where I'll try to demystify all things mortgage related. If you find this content helpful, like and subscribe. So this week in mortgage news, rates got a little bit worse after last week where they had improved. And on top of that, we saw kind of a return to the illogical and lack of cause and effect with rates that we had been seeing until last week. So Tuesday and Wednesday, we were off for Labor Day. On Monday, mortgage rates got worse, and there wasn't really any kind of data that explained it. Then on Thursday, we had initial jobless claims come in. That was the report I mentioned in my last video as what I saw to be the biggest market mover of this week, and that came in lower than expected, which typically would lead to worse mortgage rates because that signifies the economy is still strong, and that leads to the Fed wanting to hike rates more. However, mortgage rates got better as a result, which to me signals that the market is kind of correcting for the illogical worsening of rates Tuesday and Wednesday. There also may be an element of not trusting those numbers because we've had initial jobless numbers come in initially lower and then get revised a little bit higher. So, but I think it's definitely, at least in part, a regression to the mean. And we're seeing that a little bit today. Rates are getting a little better, but still down overall for the week. My big takeaway from this week, and really from the last month in general, is that when there's not significant economic news, rates are probably going to get worse. They're going to try to, it's not just going to stay completely flat, and it's probably going to trend in a negative direction. However, next week we do have two pieces of pretty significant economic news, and that is the CPI report on Wednesday and the PPI report, Producer Price Index, on Thursday. Now, CPI, that is kind of the granddaddy of the economic data reports. It's the first report to show inflation from the previous month. But last month, PPI actually moved mortgage rates more than CPI. So it's worth mentioning that one, because if it comes in a lot hotter than expected, like it did last month, that very well could move mortgage rates in a negative direction. But CPI is still the one I'm focusing on more, and specifically, as I've mentioned in most of my videos talking about the market, it's the shelter component of CPI. That has come down a little bit, but is still by far the stickiest component of inflation, and it makes up by far the highest percentage of the overall inflation number. So last month, it was 7.7% year over year. So on Wednesday, if you see shelter at like 7.6%, definitely if it comes in flat at 7.7 again, that's really not good news. However, if it starts to come down a little bit more, it's been dropping about 0.1% every month. If we finally see like a 0.3 or ideally like a 0.4 or 0.5 drop to like a 7.2, 7.3% year over year shelter, that would be really good for mortgage rates. That would signify that the Fed is probably not going to hike rates for the rest of the year. As it stands, there's almost no chance they're going to hike rates this month, but November and December, it is very much up in the air, and I think inflation is really going to decide whether they do or not. So as always, if you have any questions or comments, put them below, or you can always call or text me on my cell phone. But thanks for tuning in to this week, and I will see you next time.